option price declines at the same time is our story for today. This is Greg for this is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. Also want to thank our Patreon supporters. Your support makes the complete difference in terms of the viability of our channel and is greatly appreciated. If you've enjoyed the show, please take time to like and subscribe. Today's show is concentrated on the fact that we have an unusual phenomenon happening this week as Tesla heads into the S&P 500. That phenomenon is that the stock price is rising nicely, while at the same time, the value of the options is declining. So I wanted to jump into this because we're having this problem with Tesla every time we get near a major event like the S&P. And for those of you who are trading stocks, in general, the up or down of the stock will be reflected and you know what the prices are. But the options folks are seeing a very different experience. So we wanted to use this show as an opportunity to remind folks of what's going on with this. So the first thing to consider here is that when you price an option, there are actually three components. One is time value, how much time is left. Number two is something called, I call it delta, other people are calling it theta, but how volatile is that stock? And and in this case, that term is called implied volatility. So Tesla's implied volatility is over 125 right now, a very, very high number. So the third component of pricing is something called price proximity. How close is the stock or the option to the stock price of the company, either in the money, out of the money, etc. And being in the money allows you to make money faster, but they're more expensive because of it. So what's happening right now is that there's many different ways the market makers can actually beat down unwell researched or uninformed consumers. One of them is by leveraging a tool called implied volatility. So there's a couple of interesting numbers out there right now. The biggest one in my mind is there's something called a 700 call on Tesla that expires on Friday. That 700 call, currently there are 40,000 plus call options at 700 for December 18th, 2020, and there are only like 1,200 puts. So what this suggests is that a large number of people are confident that the stock price is actually going to rise and be and at or beyond the 700. That's entirely possible. Where we are now at 630, and based on how the stock is moving, I would argue that that ain't going to happen. And in fact, not only 70 is not going to happen, I've been predicted since the beginning of the week that we don't go beyond 660 by the end of the week. And I've already stated in earlier shows that the reason I thought this was the case is that only Goldman Sachs has gone over 700 so far, and they don't really have support from any of the other big name analysts out there. So therefore, I feel like those guys are in the over 700 crowd isn't going to happen. I also think that a lot of investors have made a mistake, and the mistake is that the stock price will rise, but the impetus for it to go beyond 700 happens after the market close on Friday, not before. So I just think this is an opportunity for market makers to make a huge amount of cash off of folks that have sort of missed the mark in their analytics. I have heard comments regarding the fact that the S&P folks are entitled to start buying 3 days prior. We're not seeing that in the movement of the stock price right now, but we thought this would happen. No doubt, the stock would be beyond 700 by now. But as you know, a lot of the well laid out plans with Tesla and what's going to happen tend not to happen as planned. And you can actually lose a lot of money in the process if you're trying to use options or other instruments to make money in that space. So where we are now, it's Wednesday. there are some really smart, well-heeled, well-funded market makers that have the ability to hold that stock in a fairly tight range for a few days, even if there's huge amounts of money moving around. Now, could it blast beyond 700? Heck yeah. Will it? There, I think, about 10 billion reasons at least why that won't happen. And all that's concentrated on the amount of money that the market makers make if, in fact, the stock price of Tesla stays below 700, but really all the way down to 650, someplace in that range, is where I think it's going to end up this week. And the market makers are making a killing off of consumers that are maybe just experimenting, or the hedge funds that are experimenting, but a lot of folks who are hoping that the event that pushes the stock price after 4:15 on Friday was going to happen before, and therefore we get a nice pop in the stock price to make those 700 calls profitable. So number so implied volatility means that it's entirely possible that the stock price could go 20 or $30, or at least 20 or so beyond what the current price of the stock or price of the option is, but you make no money. And the reason is that when you bought those options, you have an implied volatility component of the pricing. And once that volatility disappears, that price will get smashed like a pancake way down. And so we're kind of seeing that already, where we're having to pay huge prices or very high premiums in order to buy options right now. And despite paying those very high prices, the stock price is moving nicely, 10, 20, even 30 points up. And there's little or no profit attached to those options. And implied volatility is the reason for this. How do you deal with this? Solutions for it? I'd say number one, the Taleb effect, a black swan. You take a fairly small amount of position, and if it goes great, you win. If you don't, you're out. Another option is to simply buy the stock and maybe lever up 2 to 1, 3 to 1 is another way to play it. A third way to do it is, some kind of a put call strategy where you're buying more calls than puts based on direction that you think the stock is going in. I think all of these are ways that you could address this or think through it in order to make money during it. The fourth way, and you don't want to hear this because this is a Tesla show, is Apple is doing really well right now. And I've been trying to get a phone and a laptop to do our show better. And for the phone that I want and the laptop that I want, they're sold out into next year. And that confirmation of increase of production by Apple because of how huge their demand unexpectedly has been is a reason why I think that it might be actually a better value right now in terms of things to consider. So what's the issue with Tesla and it not pushing past 700? A lot of people are, I feel, forgetting a couple of things. One of the biggest ones is the fact that we have a 5-to-1 split we're looking at right now. So the real original value of Tesla back into the beginning of the year is basically $3,000 a share. And the question is, at $3,000 a share, there's something called a fully priced stock, and I feel like that's where we are right now. So there's a thing that everyone's trying to figure out and that we'd like to put some numbers around related to where are we with the S&P 500, S&P 100 indexes that have to be a part of it. So the way things work is we've asked our viewers, and there's a book by Peter Lynch called One Up on Wall Street. So if you look down below the video, you'll see that we have the title of the book and the author there. Highly encourage you to read that because he was considered the world's best fund manager when he did it, and I still think he is. And one of the things he talks about is growth rates. So the way you determine the value of a stock is you multiply its earnings times its growth rate. And if the number for the price is well above its growth rate, it's not a great buy for a fund manager. If it's well below its growth rate, it's actually what's called a value investment because you're getting all these benefits like a rising stock price, et cetera, associated with a company that's, if you will, undervalued, which is kind of where Apple is confirmed to be right now based on the shortages of all their products, even though it's such a huge company. But in the case of Tesla, because of its S&P inclusion price bump, it's well beyond its current fundamentals as a company. So the big mystery that everyone's trying to figure out, frankly, even us, is what's going to happen on Friday. There's $80 billion that has to be purchased. In theory, that could start early, is the suggestion that's been made by different folks, in that they're allowed to start buying 3 days prior or 3 days after the entry into the S&P. So in theory, today, Wednesday, would be the start of that 3-day process. The challenge that I'm seeing here, or the intrigue I'm seeing, is that I believe for the institutions, half of all the money out there currently is actually index money, be it, and the S&P being the largest. I think the S&P probably takes up definitely 30% of the money, but it could be as high as 50% of the money within institutions or indices tied to the S&P. Now, as you know, there are these numbers being thrown out. 17% of the S&P is index. S&P, the money involved is about 11.1 trillion dollars. 1.5% of the fund is actually is going to be allocated to Tesla, and that number works out to 80 billion at Tesla's current market cap. So yes, we're going to see a nice push on price on Friday after the hours. The question mark is, number one, how high does that price go? And number two, how long does it stay there? Well, I think that at least for a day or a trading day, possibly two, we're going to see a very high price for Tesla. And how high is that price going to be? Well, that really depends. We clearly know what the S&P 500 digit is going to be. The issue is that there are a lot of other entities that have to stay compliant even if they're not official. So in theory, there's another 20, $30 billion worth of buying that has to occur in order to get funds that are not hermetically tied to the S&P covenants to be in. So that's actually a very big number, representing 20-25% of the shares of Tesla out there. And that's what we're all waiting for, is to find out how this is going to play out. The question is, where are the shares going to come from to feed this beast? Because we've gone through the numbers numerous times to show that their float for Tesla is actually fairly low, given that Elon owns so much, and there are a lot of large holders who don't plan on selling. What I've been intrigued by is a conversation within the house, let's say, of Fidelity, where there are certain managers. An example would be big cap growth. So Tesla is a big cap company and it's growing. So it meets the screens of a number of entities that have to be in. The problem that happens, though, is that these managers have certain parameters that make sense for them to invest into. And once Tesla enters the S&P, there's a number that they will sell out at, and they will not buy back in, because they need for the stock price to drop low enough for it to enter the realm of being a value stock. So in essence, a manager has to sit back and say, hey, I can make some money off Tesla right now. We own it, but we have to kind of cycle out of it because we've made so much money and the fundamentals of the company so deviate from what we're allowed to use as our screen parameter that we've got to get out. So in theory, half the institutional money is indices, and in theory, the other half, maybe it's a quarter of the shares out there, are being actively invested by managers who are paid to use different techniques to identify great stocks that they should be investing in. So this is where the answer is going to come up, because the shortage of shares is so severe and the indices have no choice but to pay as high a price as the market is demanding for the shares that are available. So how they behave is the question. Sort of, one, how big are they? And B, how they behave is what's going to determine where Tesla's stock price is in the next 4 or 5 trading days. It's my belief that a lot of the smart people on Wall Street I've spoken with have been saying, look, we're going to see the stock price spike nicely at the end here, and then it's going to come crashing down. So a lot of the people that are trading it are actually buying puts on the other side, i.e. puts on for the 24th rather than calls, because yeah, they know the price is going to rise as everything gets worked out for who's going to own the shares and at what price. But then we're going to see a sort of colossal collapse back to something that resembles a viable share price relative to the growth rate of the company. So the answer to this whole thing is sort of then held by share sales by large institutions that own a large amount of shares. And I actually have shared on several occasions that I thought it was comical because as this happens, all the people buying the shares are going to be sitting across the hall from the people selling the shares. So their negotiation process is going to be fun to watch and fun to watch sort of how it plays out. Now, what could happen here, I think there are kind of, I guess there are three scenarios. Scenario number one is that they quickly sell out at the close, maybe in the after or pre-market, and get rid of those shares at very high prices and show great return numbers for their fund for having sold it. The second possibility is that for those that don't sell out immediately, there are those that could, in theory, hang on because it's still a big cap growth name and say, hey, we just chose to stay in, and they could lose a lot of money if the stock price falls, but the lack of their shares in the marketplace could influence what the price ends up being. The third possibility is that they quickly sell out, they satiate all the demand that's held out there in the marketplace, and that's when, after there's no more demand and there's plenty of supply of shares, that we see the stock price fall quickly. Now, the problem with the falling stock price idea is it totally makes sense in terms of discussing, but there are a lot of things that don't make sense with Tesla. What's fascinating to me is, hey, what if all of the crisscrossing funds, think about the funds that are impacted by Tesla, the NASDAQ 100 fund, the S&P 500, S&P 100. Those are the three of the biggest funds. There's the Russell 2000. There are all these other funds out there. What I'm trying to angle at is the fact that the higher the number of indices that are required to buy, the lower the chance that the stock price is going to fall. So when you combine these different working elements, what you end up with is an interesting situation where, in theory, Tesla's stock price could actually stay very high for a very long period of time until Elon decides to issue more shares. And the reason is that, hey, 50%, well, what we've discussed basically is call it 20 to 25% of the shares should change hands in the next sort of 5 trading days. And the problem that pops up is that, yes, they're going to trade hands, but it turns out that most of the people that are buying in are not looking to flip. The hedge funds or individuals will be able to make some money as this happens, but there won't be a mass flipping process. So this is where the unknown is. What are the floating shares out there, call it between 10 and 20% of the shares, going to do? Are they going to hold? Are they going to sell quickly, creating liquidity? The answer is nobody knows for sure, hence the high delta premium that we have currently, or the high implied volatility, because we're going to find out what the answer is. But when we're in the unknown zone, it's very expensive to get in on the options side, even if you can just trade the stock regularly. So, what do I think is going to happen? I think that this is why we've done so many shows on chaos with the S&P. The S&P's estimation is this is going to create chaos, and it's going to be a huge problem for them, because there is the prospect that if not enough people sell, price stays very high, and there's still a shortage of shares because the entities buying the shares can't sell them because they have to have that allocation. So at this point, we're still in the unknown zone. Will enough funds that own the shares / hedge funds and individuals sell enough shares to ensure that we don't grind the S&P to a halt? And the answer is there's no clear answer to that question yet. The answer is it should be yeah, because in theory your bid ask could go very high, 1,000, 1,200, maybe $1,500 a share in theory, and then now you get enough shares for everybody to have what they need in their allocation. What if, and the what if that's lurking out there is, what if those individuals, the size of the institutional ownership and retention is so large that we just don't have the free shares uh, to mitigate the price spike of the stock. And so that's what the billion, or that's the $100 billion question right now, is how is that going to play out? And the answer is we're going to find out. And most of the Sharpies on Wall Street are saying the answer is the stock price is going to spike to grab shares needed and then take a terrific fall on the back end of that. So as we get more information, we'll see. Today's suggestion is within 3 days of this happening, and the stock price should spike. But if it doesn't, the suggestion made of the fact that people will start buying 3 days in advance that we're hearing, I think that's bunk. And I'm not seeing the buying in the pre-market yet. Wasn't seeing it yesterday on the stock price fall. So I don't know how valid that analysis might be in this situation. So we will keep you posted, but be aware, choose your options carefully. Leaps and all those things are safe on the put and call side. I really think that, the fundamentals for the company suggest the stock price between 600 and 650, which is kind of where we're at. So ownership of shares actually might be a superior strategy right now to be considered. At any rate, this concludes our discussion of the stock price and kind of what's going on there. We want to switch now to our health tips. Just want to remind you, 25 leg lifts per leg will strengthen quad muscles, limiting the knee issues. And I actually have my leg weights here. So this is an example of a 5-pound leg weight. Fairly inexpensive. You just strap it on your leg while you're seated and lift your leg 20 times. So I'm keeping it handy so I can do it as soon as the show's over. The second thing is, remember, no more than once a week fried foods. Also encourage you to consider a 5-2 or some other fasting diet as a mental health and physical health consideration. Also wanted to encourage you to consider same bedtime and wake time for a couple of weeks, letting your body get into kind of a circadian rhythm that might be helpful. And if you're prior to lovemaking, consider a small salad instead of a big meal, because the food digestion there will divert blood flow from other activities within the body, therefore diminishing that experience. So a few things to consider, and we look forward to your comments on our show, particularly constructive ones. Please remember to like and subscribe, and we look forward to heavy coverage as we enter the S&P process right now. This is Greg for Teslafaninsight. Tschüss German, au revoir French, lehitro, hoda hafez Farsi, assalamu alaikum Muslim, namaste Hindi, zdravstvuyte, hello in Russian, ni hao mahalo in Chinese, ohio gozaimasu Japanese, hey do Swedish, and in Jamaica, we say, "Nuff respect, walk, good man." Thanks for joining us. Have a great day, and bye for now.